speaking of retail, Carl Icahn is making a big bet against mall operators. This, according to the Wall Street Journal, one that could reportedly net him $400 million or more if he is right. Now, it might seem like a smart call with store closures this year already at record levels, but it's not one that's paid off for others who've made that very same bet. Check out the chart of the CNBC at a 6, which tracks mall operator debt. It's actually one of the riskier tranches of the debt. Icahn would make money if this index drops. That hasn't paid off so far in 2019. But could things be about to change? Let's bring in James Sullivan, Managing Director of Equity Research at BTIG. Jim, great to have you with us.
Good to be here.
Why haven't all these sort of ingredients of mall stress added up to stress for the debt and stress for the mall operators?
Well, I think where the stress has occurred is in the equity market. So owners of B malls have gotten killed over the last couple of years, and a very good reason. When retailers are closing stores, they're closing stores in B malls. They're opening stores or keeping stores in A malls. And when they want to renegotiate leases, it's easier in a B mall than in an A mall. So, generally speaking, the B malls have seen a lot of damage, and this goes back 3 to 4 years. And it really began when Sears began to accelerate the store closings. So it's been a difficult trade for the equity markets. In the debt markets, on an individual asset basis, we've seen mall owners hand back the keys, as they say, on certain assets. So we've seen that happen. But in this CMBX 6, as we understand it, the coverage ratios are basically pretty good. This is a trade that has some casualties. We've had Alder Hill that took a very big position and was marketing their position on the street. And obviously they got some adherents, and Alder Hill had to close down. The losses were too big. That was a fairly small hedge fund. Icahn obviously has credibility, and he has deep pockets. He's a billionaire. We're not, at least I'm not. And so it's a trade that I think has gotten the attention of people. And, he's been in this trade for a couple of months, but we had, a big feature article today in the Journal highlighted.
What would the timing be better from this point on, given we have the holiday shopping season and potential closures on the other side?
Well, we've had a lot of closures already this year. And between now and the end of the year, are we going to have another retailer fail? It's tough to call that. But, Forever 21 was a major Chapter 11 filing. When they filed, they had 500 stores in the U.S. They said they were going to close 200. They closed half of that. They closed 9,500 stores. The other 100 stores, they renegotiated the leases. So we're seeing troubled retailers who maybe have a chance at reorganizing, being able to renegotiate their terms with the mall owners. The A mall players are generally, in spite of what people have characterized as a retail apocalypse, occupancy rates have been pretty steady. Rental rate growth with retailers like an L Brands or a Cheesecake Factory have been fine. But they have had to give concessions to the weaker retailers. And the result is that the internal growth rate is a little bit lower than people have expected. But it's growth. And for a debt holder, from a credit standpoint, the metrics are pretty good. And that's what the people who are long, or the institutions that are long CMBX 6 are looking at.
Let me ask you, if rates move up, what does that do to Icahn? I mean, I would assume it would help Icahn's trade because you have cap rates for property values going down, and interest, servicing would be more expensive. How much would rates need to move?
Well, I think that rates going up really cut both ways. If rates are rising because retail sales are rising and consumer health is good, then that's going to be, should be an offsetting positive. The rates on the CMBX are pretty much fixed. So to the extent that it's going to impact the refinancing of the debt, that's an issue. So in really close calls, sure, there can be an asset or two that might have a problem. But will the entire tranche get killed in that kind of environment? I don't think so. And so far, bets on rising rates haven't, so far they've been misplaced, is the way I would put it. So, I think CMBX issue, it's been painful. There's casualties. There may be more. And just as there are billionaires like Icahn making that bet, there are billionaires like Buffett making the long bet with a company like Seritage.
All right. Jim, thank you. Jim Sullivan of BTIG. What do you say on this sort of? I feel like we talk about this sort of trade every few years.
Yeah, we do. And and his point is well taken that people have tried and failed. And maybe, Carl, is it the timing? I think I can't get inside his head, but I think Mr. Icahn looks at it and says, well, these equities have gotten crushed. Where can I take advantage of it? I mean, like if Tanger Outlet, SKT, was a $43 stock a year and a half, 2 years ago. It's trading 15 now with a 50% short interest. So people have done well shorting the equities. It doesn't necessarily mean they're going to do well with the debt. And maybe the real play is, and again, I can't get inside his head, maybe the real play is buying some of these things that have just gotten taken out to the woodshed for the inevitable short covering rally that we've seen in just about everything of that magnitude.